Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'm going to be your host today. And I'm really excited to have Joe Fairless with us today. Joe is the co-founder of Ashcroft Capital, which is a multifamily syndication group that has $2.7 billion worth of assets under management. He's the founder of the Best Ever Real Estate podcast, which is the longest running daily real estate podcast out there. And he's also the author of the Best Real Estate Investing Advice Ever and an LP in just 120 deals. So you kind of know what you're talking about, Joe. Excited to have you on the show. Thanks so much for joining us.
Well, I'm grateful to be here and looking forward to our conversation.
Awesome. Well, let's go ahead and just jump right in. Can you tell the audience a little bit more about yourself, more than what we shared in the intro, and how you came to be a multifamily syndicator?
Sure. So I'm from Texas originally. I live in Cincinnati, Ohio now, and I'll get to how I got here. But from Texas originally, went to Texas Tech, which is in Lubbock, Texas, and then after graduating, went straight to New York City. And quite the culture change from cows and cotton in Lubbock to concrete and skyscrapers in New York City. I moved there because I wanted to compete with the best of the best in advertising. That was my major, and I was making $30,000 right out of the gate as a junior project manager. Had about $15K in student debt, and my check I got every 2 weeks was about $750. So
living in New York City, you're making $1,500 a month essentially.
Take home, yeah.
Unreal.
This was in 2005. Yeah, so I lived in East Flatbush, Brooklyn for my first year, and then I moved to East Village years 2 through 10. And years 2 through 10, I always had a roommate from Craigslist. Usually they're from Craigslist. It was a 2-bedroom apartment, the size of everyone's closet that's listening to this show. No kitchen, just or no living room, just a kitchen, a bathroom. One of the bedrooms didn't have windows. So when it was my turn to have that bedroom, because usually my roommates and I would switch off 6 months here and switch the other gets the bedroom with the windows for 6 months. I'd put we just had a dorm style refrigerator, so I'd put a washcloth in the little slot freezer. That was part of it, and I would get it really cold, and then before I went to bed, I'd put it on my forehead, and then I'd wake up around 3 a.m. and it'd be warm again, so then I'd go swap it out for a different washcloth.
So no air conditioner either, is what I'm hearing?
No. Well, it was windowless. Oh yeah, no AC, and it was windowless. One of the rooms was windowless, so that's what I used to cool myself down for the time I was there in the summers. And my friend would make fun of me. They, in a joking way, obviously, but they'd be like, "You're living like a college kid. What are you doing?" And they'd be upgrading to studio apartments as they made more money and one bedrooms, very luxurious. And instead, as I was climbing the ladder, and I ended up being a youngest vice president of a New York City advertising agency, making $150,000 base. And as I climbed the corporate ladder, I kept my living expenses really low and fixed, relatively speaking, for New York standards, by staying there, always having a Craigslist roommate. And I would save money. And my first house that I bought was in Dallas, Texas, even though I was living in New York City, and I saved up $20,000 and bought it for $76,000 in 2009, and then I saved up $12,000, bought another house at 10% down, saved up money again for my third, and then bought my fourth with a line of credit from American Airlines Credit Union. I had a $40K line of credit and bought it for $35,000, and then $5,000 to get it fixed up. Cost more than that. but
Sure.
lessons learned on that.
Yeah.
And so what happened is along the way, I realized that I was making $250 a month on each of these homes in my spreadsheet,
Yeah.
but not in reality, because
Okay.
someone would move out, and when they moved out, there's $2,000, $3,000, $4,000 sometimes to get it move-in ready again, and so that $250 a month would get wiped away because of these make ready costs. And so I
Sure.
realized it wasn't making that much of a positive impact on my finances. Net worth, absolutely,
Hmm.
but cash flow, not so much. And
Okay.
so I started studying different ways um, to help with cash flow, and that's when I started looking at apartment buildings. And I was teaching a class in New York City on the side, because my colleagues and friends would say, well, how are you buying these homes? You own how many homes? But you live here, right? I mean, yeah, I live here, but I'm buying them where the numbers are better. And I had a couple people say, well, if this is interesting, but I don't want to do any of the work. So if you ever do something larger, let me know. And I heard that a couple times. And
Yeah.
so that motivated me, along with me seeing the writing on the wall with the cash flow or lack thereof, to then look at some larger stuff.
Awesome. Awesome. So that's, I mean, it sounds like a similar journey that most operators that we talk to in this space, they have a single family story, they're hustling. I'm excited to hear that you were frugal with your dollars early on, and that's really what allowed you to get into the space. But it's not an uncommon journey to hear people go single family and then start to look at the multifamily space. I did the same thing. I bought singles in Kansas City and Atlanta, and had that same dream. I had some, I had a air conditioning unit get stolen.
Yeah.
Which is worse than $250 a month going by, or an $8,000 roof, or a $5,000 plumbing issue, and I had a bunch of those things. So the whole
If someone steals your roof, you really need to install some cameras.
yeah, no kidding. We had with the single with the stolen AC unit. They actually stole it the day we had some tenants moving in after about a 9-month
Wonderful.
renovation. So yeah,
Impeccable timing.
yeah, lots of fun. But well, very good. So you're living in New York, and you're an advertising executive. And where were you buying the singles at the time?
Dallas Fort Worth.
Dallas Fort Worth. Okay.
Where I'm from.
Okay. Perfect. Which
So
makes
I
a
knew
lot
the
of
area
sense.
real well.
Perfect.
Are you interested in real estate investing but don't know where to get started, or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
So you start getting this idea about the multifamily. Did you go out and get educated somewhere on that? Obviously, you've got a podcast now where you've done a ton of education for a lot of years in the space, but did you just jump in and figure this out yourself, or did you have a mentor? What did that look like?
I read a bunch of books, and I would reach out to authors. I'd ask them questions. One of the authors ended up teaching me some basic stuff. So it was more of a consultant role. This is when I had my full-time job. So what I did is I called sample life experiences while I had my full-time job, because I was able to do stuff after hours and on weekends that I wanted to really see. Okay, what am I doing after my advertising career? Because I wasn't fulfilled anymore. Once I reached a certain level in advertising, I just wasn't fulfilled by it. So I wanted to sample different experiences in life and see what I was most interested in.
Okay, interesting. And so, did you start off with like small multi, or did you start off with something big with some partners, or what did those first multifamily deals look like?
There was a first multifamily deal, and it was 168 unit property.
No kidding. Out of the gates.
Right. So 4 single family homes that I had, and then I went from that to a 168 unit property. And it was rather ambitious of me, and I made every mistake in the book, and learned a lot of lessons the hard way. And so one thing that I, looking at that property, I had 12 investors in the deal, and it ended up losing money. And I have had those calls with the investors and told them that I don't know how long it's going to take, but I'm going to pay you back plus 14% return out of my own pocket. And that's what I did after took about a couple years, I think about two or so years. And I did that. But prior to that conversation take place, and prior to, that end result, I moved from New York City to where the property is located, or was located. We since sold it, in Cincinnati. And I moved to the property. I lived in the model unit, and I would pack up all my stuff in the morning, and I would walk to the leasing office, and then I would sell the apartments and show the model unit to prospective tenants. I'd pack up my toothbrush and everything else. And so, in the evenings, I'd go to Home Depot and put the asphalt filler in my Toyota Corolla's trunk, and then go pop the trunk at the property and then fill it in the evenings. So I did all of this. I did a bunch of stuff, very hands-on. It taught me many lessons. One of them is that you can work really hard and put a lot of effort towards something and want it to do well. But if you haven't set yourself up for success, or if you are trying to solve it with simply rolling up your sleeves, sometimes that's not going to be enough. There's other angles we've got to approach challenges. And I like I said, I learned 50 plus lessons from that deal. But that was one of them.
And so did you take this one down all on your own with your 12 investors, or did you have other operational partners or anybody else on the team? It was just you.
Well, it was me, 12 investors, plus the brokers who had the deal. They brought a small group of investors in, and they put in their commissions also, or a portion of their commissions. So in total, the raise was about 1.2 million. And that was it. I had a third-party property management company, but on the GP side, it was just me. And I think the brokers had a piece of it too.
And so generally what I hear in the space is you usually have a couple of new folks, and you have somebody with some experience because somebody's got to sign on the loan. How did a bank finance a deal like that if it was just you and you were brand new and getting started?
They didn't. We did a master lease with option to purchase. And that was that's how we were able to get into this large deal out of the gate. The current owner stayed on the loan, so the loan stayed, and the current owner was personally guaranteeing the loan, and so the lender was fine. It was an insurance company. The insurance company was fine with that. We just did it with a master lease and with an option to purchase later.
Unreal. I didn't realize 168 unit deals were done like that. That's amazing. So,
not
okay. So, right. And certainly not anymore. I can't imagine. Right. So,
no, I think you certainly could do it now. And I think there's actually, I think there could be an argument made that you could find some good opportunities doing it with a master lease with the option to purchase now. But that's a whole nother conversation.
Sure. Creative financing options. Actually, we've talked a little bit about those on here. So, okay, so you have this 168 unit. You're bloody knuckling it. You're doing everything yourself, like literally living in the units. Did you start looking for another asset shortly after you got this one, or was it a couple of years before you started going after the next project?
It was a couple years. We closed. You closed on the master lease in, I think, like summer of 2013.
Okay.
maybe 2012, but I'm pretty sure it was summer 2013. And then so I was before I met my current business partner. It was just me. And
Okay.
one of the other lessons I learned from that deal is that I have strengths and I have weaknesses. And as it relates to executing a business plan on a apartment community, that is a weakness of mine because I didn't have that background coming
Sure.
into it. And so I knew I needed to team up with someone that would be a strength for the business model, because the business model is solid. My execution of it was not.
That makes sense.
And so found my business partner through a mutual friend. And then we ended up buying our first property in, I think, August of 2015. So it was a couple years.
Okay. And did you buy in Cincinnati once again, or did you look into another market then? Okay.
No, the first deal, that's when we formed Ashcroft in August of 2015. The first deal was Woodglen. It's in Houston.
It is, okay.
I bought it for 14 or so million. It appraised for 21.6 about 2 years after we purchased it. Did a cash out refinance. And so I realized, okay, this is a solid business model. This is how it's supposed to be done. And off we went.
Okay. And then Ashcroft now has grown to 2.7 billion in AUM. And I think, did I see 27 full cycle deals? How many
26. We've
26
taken
full cycle
26 deals full cycle with an average LP return of 25.6%.
There's not a lot of folks out there. You do see a handful of folks approaching the $1 billion space. A few folks go over that number, but not a lot of folks with 2.7 billion in AUM. That is an impressive accomplishment, no doubt. So fast forward, and actually about a decade you've been doing this as well. So not just a couple of years, you've been through certainly the ups. Over the last couple of years, we've had some challenges. So what's the current portfolio look like?
Focus is on operations with the current portfolio. So, we this past April, we did our first capital call, and that was for our first fund. And with 8 properties in that fund, the 3 largest properties in terms of loan size, our plan is to put them into a fixed interest rate agency debt. And that's about half of the debt for the whole fund, even though it's only 3 of the 8 properties. And then the remaining 5 properties, our plan is to sell when it's more advantageous to sell. And the reason why we we're in that position is because we chose to put floating interest rates with rate caps on those properties. That strategy was helpful on those 26 exits that we had, because it allowed us to exit out earlier and capitalize on the valuation that we were getting without a prepayment penalty. But it didn't work on when interest rates were rising as much as they rose. And so what I look at when that first deal didn't go well, I called all 12 investors. Well, on this when we had to announce the capital call on this first fund, we called all 1,097 investors, talked to about 90% of them, I'd say, and just talk. First off, listen. That's the first thing we do. Answer questions second, and then bring up any relevant talking points that they haven't been brought up third. That's the order of priority on those calls. And I'd say, by and large, investors understood. And most important, because I'm also an LP on deals. Obviously, I'm an LP and GP with Ashcroft, my company, but I'm also an LP, as you mentioned at the beginning of the show, on over 120 deals currently. And so I also have been on the receiving end of capital calls. And how I look at it is, do they have a plan? And do I believe in their ability to execute the plan? Those are the 2 main questions I have. And then very close behind that is, where's my new money relative to the capital stack, and how is it being prioritized?
Okay.
Once I take a look at those three questions, then I decide to participate or not. I think I've had, there's been, as an LP, I've received capital calls on 4 deals,
Okay.
and I've participated in 3, and I did not participate in 1. And
Okay.
again, I didn't. I asked myself those questions. What's the plan? Do I think they can execute the plan? And then
Yep.
where is my new money prioritized?
Yeah. Well, and thank you for walking through that as well. I'm sure, a year ago that was not, you weren't planning on making 1,200 phone calls to investors. And that's, as an operator, that's probably one of the hardest things to do next to losing investor capital. So kudos to you and to the team. I received one of those calls from your team as well, and was not excited about it, as I'm sure you can imagine. And I actually opted not to participate. But I understand your point too. I think there's a lot of times where capital calls occur and the dollars are going towards buying another rate cap for maybe 1 year. And, I generally get really concerned in those situations because they're not really solving the problem. They're essentially kicking the can down the road, is the way that I read that. Would you agree with that? Or
Agree with that, but it depends on the deal. I mean, conceptually, I would agree with that, but there's always, what's the NOI growth been, and why is it this way, and what is taking place to get it to that point? Are they going through a J curve with renovations, and or is there new product coming that they've been fighting against, and that's 90% leased now, so the light, you can see the light at the end of the tunnel. I mean, there's all sorts of exceptions to that statement.
Okay. No, thank you for that as well. It's been, my argument has been, if a deal's going bad, why throw good money after bad? But to your point, if it's a good operator that has answers and has a plan to overcome the challenges that they're currently going through, then I think it can make a lot of sense.
I also look at the return on that being not just the return, any type of pref I might get on my capital call dollars, but I look at it a return of my original principal that I invested as an LP, and that helping secure that return. So if you originally invested $100,000 and it's a $25,000 capital call, well, if I can invest $25K to then return back my original $100K versus being forced to sell, then that those numbers make sense. Again, assuming that those 3 boxes are checked that I mentioned earlier of what's do they have a plan? Do I believe they can execute the plan? And how is my money prioritized?
Okay. No, that makes sense. And so the fund where you guys had the capital call, what's the dollar size of that, the AUM of that fund, ballpark?
600 million.
600.
So.
Okay.
Yeah.
So there's another 2.1 billion, 2 billion that are in other funds and other projects that you guys are working on. How do those assets look? Are they performing well? Do they look strong? Did you have similar issues with those?
The assets themselves, just so we're speaking the same language, the assets themselves are performing. It's the capital market. So if you look at the NOI growth across the portfolio, it's depending on the project, but in general, we are at where we need to be. But the 2021 was a peak. So projects purchased in around 2021, in hindsight, they're going to have a higher valuation, or they're going to have a lower valuation than what they were purchased for. So those deals for any operator, they're the ones, especially depending on the type of debt that the operator has, they're the ones that you'll want to take a close look at. So as an LP, those are likely the investments that are more have lower valuation than other investments, and that's what I've seen. As an LP, the deals that are more seasoned, purchased prior to 2021 generally are doing better and have a higher valuation versus the ones that have purchased around that period of time.
Yeah, that makes sense. And I'm an LP in 25 different projects, and about half of my projects are paused at this point.
Mm-hmm.
And I've received capital calls on 2 projects, and one other that I'm pretty concerned about at this point.
Mm-hmm.
Non-real estate LP in investments. So
what is it?
It's
what type of investment?
So it's when, goodness, I would end up giving away who the operator is if I shared what it is, but it's a non-real estate financial tool that's used in a retail setting. We'll just say that.
Got it.
Yeah.
Okay. Fair enough.
So it's been a difficult couple of years for operators. I think we're coming out the back end of that. Well, I think one could argue that the deals that we're seeing today are far better than what we've seen in a few years, the ones that are actually getting done. Are you seeing that with your team and with the new fund you guys are putting together or have put together?
Well, what I see is that there will be a severe undersupply of apartments starting in about 12 months. It's a fact. Outside of some black swan event, that will happen because there's a ton of supply that's hitting the market now. Historically, it's a once in a generation supply wave of new product, and that is because of 2008. Nothing was built for a couple years. Then from 2012 to 2022. There were actually more households formed, about 3 million more households formed than apartments created, housing created. So you still got more of a deficit. And then you've got new product that new projects penciled during lower interest rate loans. But once they raised interest rates, developers are getting different jobs. I mean, they're not only not developing, they're just going into other occupations. And so where does that leave us right now? Well, you got a bunch of supply hitting the market. To give you some context, the average completed units for multifamily all the way back to 2000 for one calendar year. So the average calendar year for completed units is 217,000 compared to this year to date, 284,000. So halfway through the year, there's been 284,000 completed units when the full calendar year average over the last 23 years has been 217.
Sure.
I mean, mind-boggling. Yeah. But then you need to to underscore that with the average occupancy right now is 94.2%.
Right.
And that's held steady the last 3 months. So what does that all mean? Well, it means that we got a bunch of supply, but we got a lot of demand that's keeping up with the supply. So what happens when the supply turns off? Because that's happening. I mean, not since the 1970s has there been such a stark contrast in completed units versus started units. There's been over 60,000 more completed units this year than started units. I mean, it's about to fall off a cliff. Yeah. And we're going to see a 180 on the narrative in about 12 months for apartments. And it's not optimism. It's just supply and demand. And it's reading, the charts, because if you're a multifamily developer, you have to apply for a permit. Those permits are public record. And these are the records that I'm referencing. And so, I see that, and other operators see that. And because of that, there's not that many for sale. There's not a lot of deals for sale. Operators are holding on for a longer period of time so that they can get to that period of time, 2026, and be on the receiving end of some good supply-demand dynamics. So the project we have now, Braxton, that's in Orlando, 5 minutes from Disney, it's got those supply-demand dynamics where it's a great value-add deal, even though it's 2021, because you can raise the rents relative to the market because it's been competing against new development. Surprise, surprise. But once
Yeah.
that new development is leased up, which right now it's about 70%, you simply raise the rents, you add value, and it's much better value add than, say, investing $10,000 in a unit to raise the rent. This
Sure.
way you don't even need to raise the rent. The reason why they're
Yeah.
selling a loan that's becoming due. So
Interesting.
you're only going to have that as general partners for about 12 months or so, and then
Okay.
after that we're going to see the narrative change, and you won't see in the headlines that supply is a thing. You'll see that there's a lot of demand and very little supply.
Got it. So do you think the shift will be strong enough to save some of those 21, 22 acquisitions that occurred over the next 12 months or so?
Well, it depends on the deal. Depends on what
Sure.
the operator bought it for. Depends on but
Right.
when you have more demand than supply, prices go up.
Right.
So
Right.
in 12 months, we're about to have more demand than supply. So in
Yep.
theory, prices will go up, which will help the valuations for any apartment community.
Yeah.
Regardless of when
rents
it
will
was
go up
purchased.
as well. And yeah, everything will go up. So interesting. Well, very good. Yeah, it's been an interesting couple of years, and I know investors as a whole are very cautious today. That seems to be the theme over the last year or so, and it feels like people are even more cautious now than even just 6 months ago. Is the experience that we're seeing. But my messaging has been clear that I agree with you. This survive to 25, and if we're buying assets with a 3 to 5 year hold period, clearly by the time we get halfway through that window, the demand dynamics are going to be such that values should be increasing pretty dramatically again. I doubt that we'll see them raised the same way we did back in 19 and 20, but certainly it's going to be a strong market for multifamily operators here in the future. So that's a great perspective, and I'm really glad that you walked through some of those challenging situations that people are going through, because LPs, that's the last thing in the world that people want to hear is a capital call. I guess second to loss of capital. So it's great to hear your team is doing so well with that, and your investors have got behind you and trust that you guys are skilled enough to navigate through these challenging times, and the new portfolio or the newer portfolio will continue to be stronger and stronger. So thank you for walking through that.
Hey, as I mentioned before we started recording, any question asked me. I'm an LP and I'm a GP, and I'm also a human being who just wants to add value. So I'm grateful for our conversation.
Yeah. Well, thank you. Well, I do have a few other questions I'd love to ask if you have a couple of minutes before we wrap up here.
Sure.
Very good. So I know, actually, I had your book sitting on my desk for the last 2 weeks. We had to reschedule. I put it away. But if you had to share one educational resource for the new or newer passive investor, what would you suggest to that individual?
I wrote the foreword for this book, so I did not write the book, but I love the book, and it's Travis Watts's passive investing book. So if you look up Travis Watts passive investing book, you'll come across it. It's very practical.
Okay, very good. And oddly enough, I'm a big fan of Travis, and I don't know that I've read that book yet. I will get on Amazon and buy that today. That's funny. I think we had him on 2 years ago when we first got started with the podcast. So
Nice.
Very good. We'll go out there and look for that. Kind of a couple of fun questions here. Do you have a recent bucket list item that you've checked off of your bucket list, or one you hope to in the near future?
Surprisingly, there was this past 4th of July. I didn't realize it was a bucket list until after I experienced it. And then I said, you know what, this should be on everybody's bucket list because it was such a cool experience. My wife and my young daughter, and I rode to a fireworks show locally. It was just unexpected how awesome the fireworks was, and it was over this lake that we were able to watch it. And just the unexpected nature of it, and we were up really late relative to when a young child should be up, and so it was just a cool thing. And I said, that is a bucket list to go visit, go do something unexpected on the 4th of July and see. We were kind of up close, really, really close.
Yeah.
Probably a little too close, but see the grand nature of it and just experience something like that with your family.
Yeah, very neat. And to see it through the eyes of a little one too can often add another angle to it. So thank you for sharing that. That's neat. One thing we spend quite a bit of time on with this show is talking about due diligence. So for the newer passive investor, are there any due diligence questions that are maybe outside of the norm? Everybody talks about track record and looking at the debt, but are there any due diligence questions that you think are more important than others?
NOI growth.
Okay.
Because it's less about the track record of the exits. It's more about, tell me about your NOI growth on the properties, because then you can isolate cap compression from execution of a business plan.
Great question. I'm watching NOI growth on my portfolio closer than ever today, because ultimately that was what dictates the value. So very good. And then one final question we like to ask everybody: if you had $100,000 that you had to invest within the next week, but you couldn't put it in your own deal, where would you put that $100,000?
I think my mind immediately goes to personal development and finding a way to educate myself more and be surrounded by even more people who can help me elevate my game. So I would do more research on how to invest it on a personal development or from a personal development standpoint, because you take you with you from every deal. On every deal, you take you with you. So, focus on development of myself, and then that will pay bigger dividends than any one-off investment would if I can't invest in my own deals.
And then, if you're comfortable, would you share where you spent your last professional debt?
This book I'm reading right now.
Okay, love it.
David Gogg, I'm in the process of reading that. So that's where I spent my last professional dollars. It's a good book.
Very good. Very good. Well, Joe, thank you so much. I appreciate you coming on the show. We had the difficult discussion around capital calls and pause distribution, so thank you for that. And good luck on the next raise with the current fund. Thanks so much.
Cool. Well, thanks, Randy. Thanks, everyone.
Awesome. All right. And to the audience, as always, we encourage you to continue your education journey in passive investing. But more importantly than that, we encourage you to take action and make the decision to make that first passive investment. I am convinced that once you do, you will be so happy that you did and just wish that you had started sooner. So be sure to join us again next Thursday for another great episode. And thanks so much for joining us today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.